Good afternoon, everyone, and we will go ahead and get started. I would like to call this RTF meeting to order on June 16th at 2 p.m. We'll go ahead and call the roll at this time. So I am present, Supervisor Anderson. Yeah, okay. Pamela Gabriel, I believe she is connected, So we will come back. Sergio Cuero with Citibank.
Present.
Hello. Ali Tarzi with JP Morgan Chase. Frank Robinson, Union Bank. Raquette Ewell, US Bank.
Hello. Good afternoon.
You are present. Thank you.
I am present.
Antonio Barbosa, Wells Fargo.
Hi, good afternoon, present.
Thank you. Elizabeth Schott, Accessity.
Hello, everyone. Good to see you.
Good to see you. Mitch Johnson, IRC. I don't see Mitch yet. Okay. Ricardo Flores, Blisk. See Ricardo yet. Adolfo Ventura with MAC Project. I don't see Adolfo yet. Stephen Russell or San Diego Housing Foundation Federation. And I see Peter Armstrong, Lakeland Housing.
Good afternoon.
Hello. Good afternoon, Peter.
Madam Chair, Ali and Mitch have had last minute issues, but we are expecting Ricardo, Steve Russell, a representative from MAC while Adolfo is out of town. And Frank, so people will be popping on, I think. Maybe they're
okay, and I'll just recognize people as they come on if I see them. My only question right now is if we have minutes or anything that we have to vote on that I would need to wait for. Do we have quorum now to do that in the event people are not on?
1, 2, 3, 4, 5, 6, 7, 8. Yes, because Mike can he can act as a alternate in this case, and he can vote.
Awesome. Okay, so let's move forward to item 2, and that would be non-agenda public comment, which will be managed by Polly. So at this time, Polly, do we have any non-agenda public comments?
As a reminder, if any attendees would like to provide public comment today, they may do so when invited by using the raise hand feature, which is located on the toolbar at the bottom of the Zoom window. The clerk will call on each speaker in turn. When called upon by the clerk, please unmute yourself when prompted and provide your comments. Public speakers are limited to 3 minutes per person. There is currently no public comment.
Okay, thank you very much. And I would like to acknowledge the presence of our LISC representative, Ricardo Flores, to see that you have popped on, and our San Diego Housing Federation representative, Stephen Russell. I see you here too. And I'll try to make sure I see folks as they come in to acknowledge for the record you are here. And at this time, since we have no non-agenda public comment, let's move on to task force member comments. And I will just ask anyone who wants to comment, go ahead and raise your hand. I'll kick it off and then we'll go to Stephen. I just want to provide a couple of updates of things that I've been talking about in this task force pretty consistently. One is just updates on the Office of Race and Equity at the City of San Diego. We, as you all know, hired our director back in August of last year. We're finally getting additional folks on board to assist in our efforts to provide trainings for our city employees and also do much more outreach to our members of the community around the vision of the office and around how we are going to deploy our community equity fund. And so this budget we just approved on Monday as a council, provided 4 additional positions to Kim Desmond, our director or chief of race and equity, which is the official title. and in addition to 2 folks that she is already bringing on board. So I'm very, very excited to see all that, she has been working on, laying a foundation for since August, really start to come to fruition within City Hall and then spread out to the community. And the second update is about the Reparations Task Force. Some of you may know that the 500-page report was released per the statute of that commissioned the task force. And that was released on June 1. And it's a really comprehensive, really historic document about the history of enslaved people in this country, and kind of makes the case for reparations, and also has some potential recommendations in the meantime as we move forward to the next stage of the task force, which is to actually draft a proposal for the state legislature. So really exciting stuff. I was supposed to be in Sacramento today celebrating that report. Happy to be here with you all, but most of you may know I did come down with COVID this week, so I'm doing fine, but I could not travel, of course, and so I just wanted to share the word and maybe do a little celebration here as well. And then the last thing is that we did approve on Tuesday, City Council, designating a Black Arts and Culture District in the city of San Diego. The 8 blocks of Imperial from 61st to 69th Street, where we will dedicate that to just honor the contributions of African Americans in San Diego. It's been a decades-long fight for members of our community since Councilman George Stevens. So we are really, really excited about that, and just putting it out there now because we're going to be looking for partners. The designation is just a very tip of the iceberg beginning, although it's very symbolic. And folks just came to talk about how, we can really have a place, and so that San Diego as a community we can embrace the Black community as we all embrace each other, right? So it was a really good time in council on Tuesday. And I just want to make sure that our hardworking task force members here know what's going on, because we will be coming back to you for ask for that. So thank you for indulging me with that time, and I will now go on over to Mr. Russell.
Great. Well, thank you, Pro Tem Montgomery Stepp, and congratulations on those 3 initiatives. I mean, it takes fortitude and time sometimes to get these things across the finish line, and so congratulations. I wanted to talk about something that we're really proud of, a program that we're piloting to train folks in our sector to be property managers. It is a certificate degree in affordable housing property management that we've worked with Tina Nobartel from the Centers of Excellence to find a home for it, first of all. So I will say our first success was with Miracosta College that created 2 cohorts of 20 students each. Those are full. Within 3 weeks of opening those up, they were full. We're using that good data to set up meetings now with community colleges, San Diego City, the City Community College, as well as Southwestern, possibly Palomar, to see about increasing this a year from now to grow the program. The intent here has been all along to train folks who are residents either of our immediate affordable housing communities or the surrounding communities to be able to have jobs in that sector. And these are career ladder jobs. So we're really pleased to report that we've had such a great response to the first cohorts. And we will look forward to expanding this program in the years ahead. And some of you on this call, I know, are going to be coming to for support. But I do want to give Merit Capital a kudos for being an early supporter of this particular effort. So thank you for the opportunity. And Pro Tem, I just want to say that this is a direct outgrowth of a conversation I had with Ellen Nash, who is disappointed we're not doing it first in Canto, but we went to the community college that was willing to give us a chance. We're going to take that now, and we're going to bring this home. So thank you for that.
Yes, well, we're very appreciative of you, and my district folks are very strong in what we want. So I'm glad to see this coming to fruition. Before I go to Peter real quick, I just want to acknowledge that Frank Robinson has also joined us. So Peter, please proceed.
I got a couple announcements. One is bittersweet. Ken Souter, Wakeland's long-term and founding CEO, has recently retired. So that's the, a little bit of the bitter part. The sweet part is I'm really enthusiastic and happy to report that, Rebecca Louie, our Chief Operating Officer, has been promoted to, serve as CEO of Wakeland. So again, I'm super excited about that. I think it's a great decision by our board. And second, just a very happy announcement that Wakeland is starting construction on a 127 unit project in Linda Vista. We got the building permit and got all the financing put together about a couple weeks ago. So, we're really appreciative of the support of our partners. Both the city and the San Diego Housing Commission are partners. Housing Commission gave us a number of project-based vouchers that are really essential to making those new units affordable to, people who are, extremely low income and potentially at risk of homelessness. In addition, this is one of the first County of San Diego surplus properties that the county had the wisdom to make available for affordable housing. It's a site that is in, very central to the county and the city of San Diego. I had an appraisal that told me that the land was worth $9 million. And, the Board of Supervisors, with Nathan Fletcher's leadership, have decided to use that site for affordable housing. So, we're super excited to get, busy on construction and looking forward to a grand opening in, about 1.5 years. But thank you to all of our partners. In addition, Chase is the lender on that project, and they gave us a really great deal on the construction and permanent financing. So just want to mention them as well.
Thank you so much for that, Peter. We'll go to Elizabeth Scott.
Yes, thanks everyone. Good to see you all, and thank you again for all those wonderful updates at the beginning of the meeting. I'm also very excited about that, particularly the Black Arts District here near the office where we're located. So super excited about those things. Wanted to mention a couple of quick things about our lending to small businesses and events we have coming up. And one just quick note, we hosted our first in-person event this week with small businesses focused on food, beverage, and hospitality-based businesses with our Brewing the American Dream event. And we had over 50 small businesses attend that, which was really successful. And it was our first in-person event in 2.5 years. So it was just wonderful to feel the energy of entrepreneurs locally and help many of those in the hospitality, food, and beverage get resources and connected. And the city actually participated in that event this week. And so just really fruitful to see that energy and the resilience of many of those businesses in that industry. But the couple of things that I'll mention is that we are still lending to both startup and existing small businesses through our traditional loan programs. We had to pause our COVID relief lending through the California Rebuilding Loan Fund through the state of California because there was a pause on the program briefly about 3 weeks ago. We do anticipate another tranche of funding coming through that program, probably within the next 2 weeks. And it'll be the last tranche of funding that we get for the region with the COVID relief funding for small business loans, and it'll be at about a 4.5% interest rate. So still lower interest rate for relief lending for those businesses that had still been affected by the COVID pandemic. So as soon as we have more information, I'll make sure this group gets that out to small businesses in case they're in need of that loan program. And it will go through until the funding is allocated, and the program will kind of sunset by at least November. And then we'll see if there's any additional funding that will become available beyond that. And then I just wanted to mention an event that we'll have coming up in July, actually, which I think is a different topic than we've done in the past, but I think really important, particularly coming off of the years that we've been through all of us. We're going to focus with a client of ours on the health and mental wellness of entrepreneurs and just the stress that it takes to run your own business, and really wanting to bring that topic to light and have a conversation about what that looks like as an entrepreneur, and just giving resources and tips and connections for the mental health and wellness of entrepreneurs. And so I'll send that out. We anticipate that it will be about a mid-July event. We are going to do that one virtually, but we're really excited about that topic and think it's very relevant coming off of the last couple of years. So I'll keep you all posted on that as well. Thank you.
Thank you so much. The awesome updates. Thank you. I don't see any more hands, and so we will go to the approval of the minutes. I would just ask if there are any changes. If not, I will certainly entertain a motion to approve the minutes of March 17th.
Make a motion.
Okay, thank you so much, Peter. And Frank, I see you seconding.
Second.
Okay. Any further discussion? If not, all in favor, I'm sure we can do a voice vote for this. So all in favor, please say aye.
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 Okay, any opposed? All right, so that passes unanimously. And at this time, we will go to Daisy for your staff report.
Thank you. Hi, everyone. It's great to see all of you. A couple of quick things, and then two short updates from other folks that I asked to talk. The first one is, as we'll hear later, and I've been monitoring on, the last couple of months, the Federal Reserve, in concert with the other regulators, which was really great, released its proposal for reforming CRA. So it's complicated, it's huge, it's 600 pages, so we'll divide it up between everybody, right? No, I'm relying on experts, including the ones that we're bringing in today, and we'll be summarizing it and sharing that out, preparing a letter as we have done before for the comments. So that's due in August, so that'll happen before we meet again. Our next meeting is in September. The bank representatives know that I have started the official start of summer and sent out the CRA's annual survey. So thank you for everyone working on that. That will be due in mid-July, and we really appreciate those efforts. It gives us incredibly rich data that we'll be presenting at the end of the year. Third, one of our biggest, longest running collective impact projects, as you know, is earned income tax credit and increasing free tax preparation services with a grant from Citi for the first 4 years. And then Citi Foundation picked up the mantle this year and provided a substantial grant that we are using both for outreach, but primarily to extend tax preparation services. The season has closed, but there were a lot of late filers, a lot of confusion. Things took longer this year. And so our main partner, Dreams for Change, who's the largest tax preparation outfit preparer service in the county, they're continuing to do refiles, late returns, do refer people to 211 or directly to Dreams for Change to make an appointment with them. I'm also really happy. I've looked at the numbers. 2020 was a normal tax year in a lot of ways for tax preparation because we didn't go into closures until we were already halfway through the season. 2021, things were really difficult. Nobody was meeting in person really, and tax preparation fell off. This year it has largely recovered. And Dreams for Change has really shouldered a lot of that burden and done a great job. So we have a great partner there and great things to report. My last two things, I've asked a couple of folks to do some updates. The Housing Commission developed and released a new ADU finance product this year. We have been talking about ADUs and finance, since before even the state legislation. And so wanted to get it right. You've all met Sujata Raman, our vice president in charge of single family finance. And I asked her if she could explain the program and tell us where things stand. Sujata, I can't hear you. I don't know about the others.
I cannot.
Can you hear me now?
There you go.
perfect. Thank you. Hi. Thank you. Thank you, Daisy, and hi, everyone. My name is Sujata Raman, and I'm the Vice President of Single Family Finance at the San Diego Housing Commission. And we are very excited to share with you that in April, the Housing Commission launched an ADU finance pilot program, which provides eligible low-income homeowners with construction loans of up to $200,000 per household. In addition, our ADU finance pilot program will provide technical assistance through a consultant at no cost to the homeowner, which is the big thing, to help with site feasibility, pre-design, permits, and construction. Homeowners may choose to construct a detached or attached ADU, including garage conversions. They also may use permit-ready design and building plans available through the City of San Diego for an added cost benefit. They can also choose a manufactured ADU or a custom designed ADU. The Housing Commission loan terms are a 1% simple interest deferred during construction, with principal and interest due upon construction completion through takeout financing by a mortgage lender. Rent for the ADU must remain affordable for 7 years for households with income up to 80% of San Diego's area median income. And then upon construction completion, the homeowner will be required to refinance. The Housing Commission has partnered with a lender for the refinance who has agreed to provide pre-approval prior to the start of the ADU construction. However, the homeowner may use any mortgage lender of their choice. The ADU loan is paid back to the Housing Commission, the construction loan, at the time of refinance, and the loan payments will be recycled into the ADU program to assist additional homeowners. The Housing Commission is currently selecting homeowners through an open application process on a first-come, first-qualified basis. I want to point out that we have plenty of funding available, and we highly encourage the RTF banks attending today to have their loan officers participate in this ADU program by submitting applications to us to help their low-income clients build equity, rental income, and generational wealth through the construction of an ADU on their property. And of course, this increases affordable housing in the city, or the addition of the ADUs. That's all I have. If anyone has any further questions about the ADU program or the parameters or anything at all, feel free to contact me directly. I think Daisy has my contact, or I can give it out here if you want, Daisy. But I think most of you know me.
We do and will. Thank you so much. We appreciate your providing the comments. We're going to do one other, the Mayor's Middle Income Working Group that we've talked about, and several of you have participated in, finished their work and have had recommendations that have moved into the next phase. I asked Steve Russell if he could give us an update on that.
Yes, thank you. Thank you, Daisy. Yeah, the Mayor's Task Force met for several months over the end of last year into this year, and it should be no surprise. I mean, we brought together, I should say the Mayor brought together some of the best minds in housing across sectors, and there's no magic sauce, right? If it was that easy to solve middle income housing, it would be done already. Notwithstanding that, we certainly did come up with some good ideas. And first of all, I would say that the mission was very, very specifically kept to creation of new housing that was available to households at 80 to 150% of area median income. Because there are lots of other ideas we had about preservation and other things, but we really narrowed the recommendations to that. And in 3 categories, we made recommendations. What could the city take as actions? What could the mayor advocate for? And how could the mayor maybe act as convener to help bring certain issues forward? So those are the 3 broad categories. And some of the highlights of that in terms of city actions that we could take is to update local codes to account for new construction materials and technology. And mass timber in particular, if you're familiar with that, is one of the technologies that might allow us to build, say, a 7/1 or a 9/1 rather than a 5/1, better using the land that we are using and releasing its full potential. So things like that are available to the code. The city could update the code almost immediately to see that was available. We talked about stormwater as a regional problem, that the cost of stormwater burdening individual projects and functionally not actually helping to address the problem very well when you're doing it on a site-by-site basis. So talking about the need for a broader stormwater infrastructure that would relieve the burden of costs from the individual, any of the housing that was being built. We also asked that they consider funding sources, including the trash fee, to subsidize deed restricted middle income housing. So we know that the People's Ordinance, I believe, is moving, showed some progress. I haven't been tracking it closely, but we've seen progress there. So those are, and there's more, resourcing the Development Services Department. Now, since those recommendations, I know they've outsourced some of the activities of DSD to make sure that they could keep up the pace, but there's still a need to focus on how do we create greater efficiencies and provide sufficient training to DSD. In mayoral advocacy, something that might be of interest here is the idea for a construction loan guarantee program that would specifically help support smaller developers. Malik infill development is one example that can't always get access to the same kind of capital that larger developers can. And at the same time, that a lot of what we're going to see in new housing is going to be infill of a smaller scale. So there's this mismatch between funding resources available and some of the needs. And so creating that kind of a loan guarantee program wouldn't even mean an outlay of the money, it would mean backstopping these loans with resources as opposed to actually spending it. Needless to say, we talked about property tax abatements for middle income housing. Addressing the construction defect liability issues that have prevented the market from providing any condominiums, because if we're going to provide tens of thousands of new homes for middle income folks, those are not going to be single family homes in the county of San Diego. We have maybe 40,000 single family home sites left that are plotted right now. It might be 50,000. We need more than that of housing opportunities, and for folks to buy in multifamily, we have to overcome certain hurdles that are being created for the creation of condominiums. And that may even be alternate forms of ownership that get outside the HOA world, like cooperatives and other sources. But that's something we see as a valuable way of providing more for sale product, new for sale product in the marketplace. There's talk about supporting a philanthropic fund to acquire middle income housing. And then moving on to mayoral convenings, really, we felt that the group that got together should continue to come together quarterly to monitor progress and offer up new ideas. But the mayor had a role that he could convene developers, designers, contractors, and labor, notably labor, around new materials and construction technologies. So there's a larger list than that. I don't know what the mayor's office has actually released, so I'm sort of leaking this to you, I think, but be happy to have a private conversation. I don't want to do it in a public forum, just throw the whole report out there. But again, I will say a lot of creative ideas. Without resources, it's going to, without actually buying down the cost in some manner, we're going to be challenged to produce and provide housing at anything below what the market is currently providing it at. Thank you.
Thank you so much, Steve. That's sobering, not surprising, but having one more voice documenting that maybe will help. And certainly all of you and all of us doing advocacy on the areas where we can move. The item was supposed to be heard at Land Use and Housing today. And it's part of the reason I didn't book a speaker besides our busy agenda. But as I understand it, they've been moved to mid-July. So it will be more public then, and we will have more information as well. But thank you for all of this, because it's been a little quiet, maybe because, like you said, there was no magic answer.
There's no splash. There's no. It's hard work, and it's hard work.
It's a reason it hasn't been solved. Yes, thank you, Madam Chair. That concludes the staff report.
Thank you so much, Daisy. And just since Stephen referenced briefly the People's Ordinance, we did vote for it to move to meet and confer, I think, on Tuesday, and that was successful. So it's in the process. At this time, let's go to our informational item number 6, special purpose credit programs. We have Yannicka Ratcliffe, as Vice President of the Housing Finance Policy Center at the Urban Institute, that is here to present. Okay, and I see you're now on the panelist side, so please proceed whenever you are ready.
Trying to get my appearance right. Good. Hello, everybody. Good to see you. And thank you for having me. I'm going to be talking about special purpose credit programs, as is mentioned, and I imagine there's a fair degree of variation in what people know about those. So I'm going to start with the basics, and there will be time for Q&A hopefully at the end. So so I do want to say that the sort of theme I'm trying to get across here is in the small print, the old tool that is finding a new potential to address some of the really pressing issues of our day. So let's move on to the next slide, please. Briefly, just so you know, the Urban Institute is a nonprofit research organization. Our research and data is focused on advancing upward mobility and equity, and the mission is to open minds, shape decisions, and offer solutions through economic and social policy research. We've been around for more than 50 years, and the Housing Finance Policy Center is focused on the housing finance system and home ownership and the effects on the economy, households, and communities. So just a little bit about us, and we can move ahead. So, and again, the next slide. So we'll take you through the old tool part of this. It comes, special purpose credit programs are enabled basically through the Equal Credit Opportunity Act, which was originally passed in 1974 and explicitly bars discrimination on the basis of protected class in any aspect of a credit program. However, they didn't really want to necessarily preclude lenders from seeking to implement programs that were kind of trying to address barriers or rectify challenges that certain classes of people had in getting credit. And so they had this specific allowance for lenders to offer programs tailored and limited to people sharing these common characteristics, which might include one of these protected class categories, so long as that program was not developed for the purposes of evading the act. And there's some links in here. The presentation will be available to all of you, but there's some resources that are linked here with some background laws and some other things you might find interesting if you want to dig a little deeper. So the next slide, please. The ECOA also laid out some pathways for these programs to be implemented, and it's a slightly different set of requirements for nonprofits versus for-profits. So for nonprofits, the special purpose credit programs can be extended for members or for an economically disadvantaged class. And then for-profits, they may be extended to people who, and it's taken verbatim there from the text, but would not receive such credit or would receive it on less favorable terms, provided that they do it under a written plan. So let us go on to learn a little bit more. And again, there's a link down there to a document by the National Fair Housing Alliance that provides some more background. And if we can go to the next slide, we'll talk about this written plan. It's pretty clear about what it takes to justify and create one of these programs. So the plan must have 4 elements. First, it needs to point out who it is that the program is trying to serve. And there's some examples provided here. Again, I've taken these straight from the CFPB guidance that is linked at the bottom of the page. Something like minority residents living in low to moderate income areas, or residents of majority Black census tracts, women-owned businesses, limited English proficiency consumers. These are all examples of the kind of class that you could design a special purpose credit program to serve. The next element of the written plan is to describe how that program or the product is designed to improve the outcomes for that particular class of person, either to make it easier for them to receive credit or to do so on more favorable terms. The plan also has to state a date that the program is expected to terminate or to be reevaluated to see if it is achieving its purpose. And then this is the part that we get excited about at the Urban Institute as we do analysis here. So the plan needs to include a justification based on analysis about why there is a need for this program. And that analysis has 2 components. One is a broad analysis that kind of can take a look at third-party data, government reports, demographic data that you can pull together yourself that describes the nature of the problem and the barriers. And then also there's a component where the plan needs to address what it is about the institution's own standards and products and procedures that are currently limiting. So it's not like you have to air dirty laundry. You might simply be saying something like, well, we underwrite to Fannie Freddie guidelines and they require a minimum credit score, and that prevents this class of people from getting credit on the same terms. Something as straightforward as that. And again, the guidance is linked there. And on the next page, we'll move on to that, the need for special purpose credit programs and how you might document that. I'm going to draw on some slides. I just have found them to be very, very good and powerful points raised by the National Fair Housing Alliance, who has done a lot of work to raise the profile of special purpose credit unions, to draw attention to it, and to get more of them out there. So these are a long list of laws, and it's probably not even comprehensive. Not all of them are specifically rules that affected the home ownership capacity of non-white households, but many of them, did limit their financial wherewithal, their ability to participate in the financial systems that we all take for granted sometimes when we think about the American dream. And then some of them, like the Homeowners Loan Corporation Act, for example, were clearly about limiting the potential of non-white households to get homes, to participate in home ownership. So if we can move on to the next slide, I'll cover that a little bit, but this is all, again, part of the background and story for making the case for why we need special purpose credit programs. So the Homeowners Loan Corporation was put into place by the federal government to stave off the wave of foreclosures coming out of the Great Depression. They developed a lot of techniques that are still used in the marketplace today, including the fully amortizing loan product. And they also drew maps about neighborhoods and what was high risk and what was low risk. So A, B, C, D, you see sort of green is A and red is D, the highest risk fourth grade. And race was a common factor that was incorporated in this redlining, which you're all probably familiar with. But if we go to the next slide, we can see on the left-hand side of the slide, the hierarchy. It's so stunning when you see these things today that this was perfectly acceptable practice back in the day, to just have this list of what is the hierarchy of different groups of people. Subsequent to that, the FHA was established in 1934 to put home ownership in reach for more middle-class neighborhoods, middle-class households. Very catalytic in creating a suburbanized America and an American middle class, but it was largely a white middle class that was created by this, and less than 2% of FHA loans in the beginning went to people of color. And again, racial segregation was really basically a requirement, or through what kind of properties and neighborhoods these loans would be made in. So to the next slide, this may be familiar to you all, I'm sure, as the Housing Commission. You've seen it, but just for purposes of illustration, this was the redlining map for San Diego from 1935, and I'm sure you're familiar. This map probably says volumes to you today about how, even though redlining is not legal anymore, how the ramifications of these practices still are with us today. So if we move to the next slide, some of the additional case making for special purpose credit is that while we have underwriting guidelines that should be racially neutral, basically they still embed barriers that definitely affect different groups differently. So in these examples, I'm talking about, for example, the effect of the 3 C's of loan making, of credit being the first C, and Black households who, through a long history of not having had equal access to banking services, more exposure to alternative credit, which are not credit building and tend to be more of debt traps. They're much more likely to be unbanked Black households. They're much more likely to be credit invisible and to have lower credit scores at all income levels. So this is just an example of the kind of justification if you wanted to do a special purpose credit program that had some flexibilities around credit score. This would be the kind of thing you would use to do that. The next C is on the next slide, is collateral. And so we've talked about redlining. There's a link there to a story that you all probably know well about restrictive covenants in San Diego, but those are examples, along with urban planning decisions and infrastructure placement and environmental hazards and appraisal bias and things that lead to neighborhoods of color who are more likely to face speculation and foreclosure, et cetera. All this led to lower wealth building and less intergenerational wealth for households of color to be able to put down big down payments. And I've also included some statistics. In San Diego, Hispanic households make up almost 23% of the households, but only hold 12% of the housing, the primary residence value. And Black households make up 6% and only hold 3% of the value of primary residence. So you can sort of see this unequal distribution of housing wealth. And then the next slide will be about the C of capacity, which encompasses ability to pay, enough income to make the monthly payments, or to qualify anyway, and also, again, cash for down payment. Lack of a down payment is the most common barrier cited for would-be homeowners, and the highest, once people apply for a mortgage, the highest declination reason, denial reason is debt to income. So not having enough income to cover the mortgage payments. Of course, there you're picking up things like employment discrimination, the lack of intergenerational wealth we've already talked about, and the way in which economic shocks, for example, in the foreclosure crisis, Black and Hispanic households lost significantly more wealth on average than white households. So I think you guys maybe are familiar with the story. There are some more resources in there if you want to dig into the details a little bit more if you're thinking about doing a special purpose credit program. But if we go to the next slide, it will, you're going to be hearing more about CRA in a little bit, but one of the things we have found is that in the past, programs that have been developed around the idea of civil rights, like the Community Reinvestment Act, have not used race as a factor, but have used income as a kind of a proxy. And we have done some research that just shows that, basically not all low to moderate income borrowers are minority borrowers, and that it is not a perfect proxy for that. So if we'll go to the next slide, you're all probably familiar. If you haven't seen the slide, you have probably seen it in your own communities. The homeownership gaps between white households and households of color stubbornly persist. They don't seem to move that much over time, especially for the Black-white homeownership gap, which is as big today as it was before, when discrimination was legal, back to some of our earlier slides. So if we could move on to the next set of points. This is the now and how this tool is being used today. And so there's some big, I think, tailwinds have come from federal agencies getting on board, providing clarification and providing guidance. So I've already given you some excerpts from the CFPB's advisory opinion. It's an excellent tool to read. I would start there if you want to learn more. Then HUD followed up with some guidance about a year later. And then several federal financial regulatory agencies combined to issue a joint interagency statement in February of this year. You will also, again, as I mentioned, hear more about CRA shortly, but there is some question in the CRA notice of proposed rulemaking, which just came out, as to whether SBCPs should be considered as examples of programs that help institutions meet their obligations to serve LMI communities in their assessment areas. And Fannie Mae and Freddie Mac just released this month their own plans to provide equitable housing finance. And in both cases, there are some references to special purpose credit programs. So I dare say we will be getting a little more clarity from them and some guidance for how they might become investors to facilitate lending under special purpose credit programs. And on the next slide, we have some examples of some real live financial institutions, some who I believe are on this call. And there's a quick summary of what the programs do and a link to press releases, news articles about their programs. So the first two have a purchase money component. They help people buy homes, and they provide some grant funding to help them do that. And it is targeted to community profile as the kind of the target of where who they're lending to. And then Wells Fargo recently announced a program around refinances. So this kind of is just to illustrate the kind of flexibility of design that you might be able to employ with a special purpose credit program. And the next slide. So this is from a blog, again, that's linked here, but it's just a way to illustrate as we're talking and thinking about the design of special purpose credit programs, some of the data and analysis you want to think about. And so we have this example of in places like Detroit, where there seems to be pretty clear-cut delineation of where non-white populations are living, that using a geographic targeting for a special purpose program ought to be pretty effective. When you look at a place like Seattle, which is more integrated and it's less clear-cut, using a geographic approach to targeting your special purpose credit program, let's say the racial makeup of a census tract, might not be as effective at reaching the target population. So that is just one illustration of how it's important to think about your market and what you're trying to accomplish. And the next slide, and I am getting near to the end here, goes a little, lays out some high-level considerations around designing special purpose credit programs. Do you want to make them people targeted or place targeted? And if you're doing it in a place, by place, you still have to answer some further questions like, are we making this program available to people who currently live in these areas, or are we making it for people who move into and are buying a home in these areas? You also, of course, want to know something deeper about what are the barriers in this particular market faced by the group that you are trying to serve. Again, the theme of the Urban Institute that, and actually this is what is written into, what is behind the idea of the written plan, is that you should pursue this in an evidence-based and data-driven way, not only in the design of the program, but also as the program is then implemented, measuring to see if you're having the effects that you wanted it to. And then the good news is that very, very soon, there will be a really handy tool that will go into a lot more detail, a lot more practical information about developing special purpose credit programs. It has been developed in partnership by the National Fair Housing Alliance and the Mortgage Bankers Association. A lot of the legwork was done by the Homeownership Corporation of America, and we had a small hand in providing some of the background content and case making for it. So we're very excited to see this and very pleased to have been a small part of a very useful tool. So that should be out within a week or so. And I believe, next slide, we're done. So thank you all. I know that was pretty fast and we covered a lot of territory, but I still think we have a little time for questions, and Daisy, you can let us know how long we have for that.
Thank you so much for the presentation. And I'm going to just make sure that we go to the public and make sure there are no public comments before I turn back to the task force members.
Any attendees wishing to provide public comment may indicate so now. There is no public comment at this time.
Okay, thank you so much. And Daisy, yeah, just on timing, I know you have everything kind of timed
We're doing
out.
good. We're doing good.
All right, cool.
If we get into a really rich, deep discussion, then we might have a decision to make. Do we cut it off, or, oh, this is a great discussion? But
Right,
let's hope we have such a problem.
Yeah, we'll just go with the flow. Okay, I got you. Mike, your hand is up. Do you have a question?
Yes, I do. Since it was on the agenda, I was reading up on the bit, and on these programs there, is it the financial institute that gets involved, and they still are fully responsible for underwriting and they take the risk? Is that correct?
Well, they take the risk if they keep the loans on their portfolios. And, there's financial institution representatives here, and I don't want to be the one to speak for what they do, but there could be aspects of a special purpose credit program that you could still make the loans and sell them to Fannie, Freddie, have FHA insurance, get primary mortgage insurance. So it sort of depends. And I don't know if anybody wants to talk about that, how they're doing it.
Okay, well, I'd just be interested because it's something I read is these have been underutilized. Is that true, or not utilized very much? Is that correct?
Historically, they have, I would say underutilized is a good way to put it. I think they've been kind of a hidden tool that just has not really
Okay.
And even, it's sort of like we've lately just found it. I don't want to overstate the case, but it seems like given the conversation around greater equity in home ownership, then what do we have at our disposal that we could do to address it? And this tool was uncovered, recovered, and has been discussed more and more lately. And so as that conversation grows, you have these lenders like that I mentioned on the slide who have started to pilot programs. There's more and more curiosity about that. Then now we have something like this toolkit, and you see the regulatory agencies helping to answer questions that might be coming up. So I do feel like it's really gaining new momentum right now.
Okay. Well, if there's anybody out there from the banking side that can answer this, it's just given San Diego's housing market and just the crazy prices, it seems like that's just, no matter what you're doing, even this, that's still a barrier. I mean, we still have to get back to figure out some way to get affordable housing, but it sounds like a great idea. I'd just be curious about the details of what kind of program would have to be offered to make a real difference for people, like $5,000 to help them with the down payment. I'm not sure, maybe that's significant, I'm not sure, but maybe it's not in San Diego market. That's just a question. Things of that nature. What would really help? What kind of program would really help? That's it.
I think Frank has his hand up, so let's go to you.
Yeah, Mike, I was going to address your question. So Union Bank, we've implemented a special purpose credit program on our business lending side, and we've operated that since 1993. I know because I ran it. So we have a program that we look at women, because technically the Equal Credit Opportunity Act was actually sometimes nicknamed the woman's law, because you could legally discriminate against a woman if, like, she was in childbearing years, you could say, we're not going to give you a loan. Or basically in the underwriting, you would say, if you get pregnant, we will call your loan. I mean, that was actually written into the law. Into loan documents. So we have it on women, minorities, and we also included veterans. And we argued the case in front of the OCC and the Federal Reserve to add veterans into that portfolio. We are now looking at lending on the residential lending side, because it's a stronger component. I think one of the things that we would have to do, besides that, because I don't think 5,000 would make it at all, is at least at $9,000 to $10,000. But in addition to that, is to partner with other organizations. We did here in San Diego the San Diego Black Home Buyer Program, which is a $40,000 matching grant. We've actually booked 23 loans to African Americans since the inception of that program in September. And those are into low to moderate income community, probably would never been able to purchase a home or been in a very difficult situation. I think that's going to move the needle. But I think your special purpose credit program, you are going to underwrite it as a bank, and then you could portfolio it, sure, but you could also sell it back. But our thing is, we would want to keep those loans on the books because of the people that we're serving. But I think we have to find the flexibility in our underwriting and the tolerance to make those deals happen. And if we're able to do that, and really purposely look at people of color, those in low to moderate income communities, you could do a whole gamut of different things. It's just based on the bank's risk tolerance.
Okay, thanks.
Thank you for that, Frank. Any additional questions, comments? Yes, Mike.
No, actually, it just hit the button.
Doing its own thing. We know how that is. Daisy, please. You are muted if you're speaking.
And it was brilliant what I said, right? No, what I said was, thank you so much for coming, Monica. I've heard you speak in other national forums, and so we were really fortunate that you were able to come and that you're spending your evening on the East Coast with us. We will definitely distribute the slides. They're very useful. This is something that I wanted to bring, we've talked about, because we're hearing about it, and the agencies sent out all these communications, do this, do this, do this. And so we're hearing, I'm hoping that there's a lot of activity behind the scenes at the banks, probing that risk tolerance, as Frank talks about, and developing products, especially around home ownership. As we, this circles back again to, what I said and Steve said during the Middle Income Task Force report. This is hard. we have no, delusions about that or illusions. And so there's a reason that maybe even special purpose programs haven't been used yet for home ownership. But I'm hopeful that the regulators do more than just encourage, and maybe the new CRA reform will also be more explicit and create more incentives. But I'm not hearing enough yet, as much as I wanted to. And I was hoping, like with all the tools at Urban, that you would know more, but it sounds like that may be actually tools where we do learn more when you all release that toolkit.
Yeah, I think that will help a lot. I'm listening to you all. We're also familiar with some of the things that San Diego is trying to do. It just strikes me that, and hearing about the ADU program, you all seem very oriented towards developing as many tools as you can. So this, to me, is one more tool in the toolkit. It can be combined with these other things, and maybe with some hope, it can help answer Mike's questions, how we can put all these things together to solve the problems you guys have there. Thank you.
Yannicka, or any of the bankers, is this something that can be done at the local level, or maybe a local homeownership CDFI might do? Or is it so much work that you need sort of maybe economies of scale to make it pay off? I see Frank nodding his head.
Yeah, a couple things. Number one, LA Reach, part of the reach of the OCC, has, and this is coming from the control of the currency, has really pushed for special purpose credit programs. And I know a lot of the banks that are on the call right now, their credit teams are actually looking into a special purpose credit program, because it's going to be a national. Each bank is going to have to derive their own program. But I think Project Reach wanted to make sure that there's some uniformity in some levels. So I know, talking to my colleagues around the other banks, they've indicated that they are all working on a special purpose credit program for the residential lending side. As you mentioned before, we have it on the business side, and we are also looking at on the residential lending side, because we are getting a lot of people inquiring about it. It is a lot of work, because it is two portfolios. It is, language difference, and where do you put it? Is a separate application? Is inclusive inside the one application? Is it a self-certification? Do you check the box? How do you verify that this person is African American? And those sort of things, and veteran status. So every bank has gone through that. I know there was one bank in Texas that just recently approved on their business side, and I did hear about Chase on the residential lending side. So I think, Daisy, to your point, I think it's coming sooner than you think. Because and I just say that because a lot of banks are already on this OCC Reach platform. In fact, I think we fly to DC at about next month to have a little summit around that. And I'll be out there in DC regarding that with Project Reach, and that's one of the biggest components of special purpose credit program.
Thank you. Madam Chair, I understand there's one public comment, if you want to reopen public comment.
Well, I do, just a reminder for the public, we just try to do comment as soon as an item is over. So I will do it this time, and then just ask the public to do that when I call for it, once a presentation is done, but we can go ahead and move and allow this discussion.
The public comment is from Carla Ruiz. Carla, you have 3 minutes. You may begin your public comment.
Thank you so much. My name is Carla Ruiz. I'm a real estate agent for over 20 years. And I just want to make a comment. Every time I see the banks getting together to find solutions, I'm very interested to learn how we can work together, because as a real estate agents, we are always seeking for ways to help and retire families from renting. That's how I call it. I heard that the Housing Commission just raised their limits purchase price at $975,000 to purchase a single family residence. But unfortunately, our AMI, it's still at 80%. So for me, it doesn't really make sense. We have to find a family that has probably more than 10 family members to be able to qualify for a house of 975. I just think that it's a very easy solution. One of the programs that I say kudos to that was the Bank of America that was just released a few years ago. I've been helping a lot of families doing the down payment assistance program where they give actually grants to the middle income, because right now prices went up and we want to utilize those programs, and the income limit is 146,000. I think it is give more opportunities to the middle class to be able to qualify for something at least, right? Unfortunately, they just switched the program that before it was no mortgage insurance, with that give you more purchase power. Now it's only, a little bit of mortgage insurance. I believe it's like around 0.52 AMI, which is still very helpful. But I think if we raise those limits, I know one time the Housing Commission, 2 years in a row, we were able to qualify buyers up to 100% AMI, and that was amazing. But with the 80%, with the prices being so high, it's really making so difficult to utilize this program. So that's my comment. And I know in addition to that, we are building 90 homes in Southeast San Diego, which is District 4, where Councilor Monica Montgomery is. She was in one of our grand openings, and we're helping families. We're doing the work. We're doing education. And I'm so glad that I was able to join here. And if you can just share with me, I wasn't able to be here at 2 o'clock, but to share those slides prior I arrived to the meeting. Thank you so much for your time.
Thank you, Carla, and thank you for everything you're doing in our community. Going back to the members, if we have any more comments. If not, we will officially say thank you to Yannicka for coming. I don't want to misspeak, but I believe the Urban Institute may have testified before the Reparations Task Force, but there's a lot going on, so it may have been something else, but a lot of the information is very similar. So I just want to thank you for being here and walking us through this so that we know that we have another tool. And with that, I will go now to our next information item number 7. This is the Federal Community Reinvestment Act overhaul. I am going to do my best. Jodis Swaroop Bawa is here with us, the Chief of Organizing and Campaigns at the California Reinvestment Coalition. Please feel free to correct me if I was wrong in pronouncing your name, but we're very grateful to have you with us this afternoon, and please proceed whenever you are ready.
Thank you so much for having me. I'm Jodis Rupawa. I shared a shortened version of the slide deck. Michelle, I'm wondering if you are available to share that, or if I should. Oh, I see it. All right, great. Thank you so much. So I think all the members of the council and esteemed participants probably know, some of this and in terms of what the CRA is, but I'll do a very brief overview. Next slide, please. Once I do the overview, I'll talk about, just for context setting, what the CRA and how it's evolved over the years, and then go into what's in the proposed rules. And then there are some next steps that I can go into and have questions. Next slide, please. So this, I think Yannicka also shared, again, is a redlining map. Financial institutions at one point, and perhaps even today, are still struggling to meet the needs of people of color. These maps were created as by way of information by the government in collaboration with banks. Red was where, and I quote, undesirables lived. Yellow was at the risk of infiltration of undesirables. And so, and I wanted to highlight that to say, some of what the previous speaker was also talking about, that, the struggle to get the banking industry to provide resources and really build wealth for all members of our community has been going on for decades. The CRA was meant to address this. CRA was created to address this history of redlining exclusion in neighborhoods of color, particularly people of color from obtaining home loans and building that intergenerational wealth. So next slide, please. The federal CRA at its core was a civil rights bill. It was the last of the civil rights victories. It was passed in 1997. 1977, sorry. Next slide, please. And before I go into more about how the CRA has evolved, I wanted to give a little bit of context to why that still matters. So forgive me, this information is from Los Angeles. I didn't have the time to tailor this, but you can see this is also redlining the areas that are still in red towards the right of the map. Are South Central Los Angeles, and the life expectancy there is 76.5 years, so about 76 years. And you go a little bit west to where the areas are green, and that's what's Culver City today. And the life expectancy is more than 10 years over what the life expectancy is in South LA. So, there are lots of people who will talk about the impact of the built environment on the health, on people's health. But, I wanted to highlight this to specifically say that exclusion from access to credit and financial stability is still bleeding into how long people live and how well they live. And that's why this matters today. Next slide, please. So here we are finally, sort of how the rule has evolved. As I mentioned, CRA passed in 1977. There were different points in history where particular things were added. CRA exams, which we believe are really important, were added just in 1995. And fast forward to the Trump administration in 2020, the federal regulators issued a rule. We believed it to be a very bad rule. The agencies were not introducing the rule together in unison, which was just the least of the problems. We sued the Trump administration. That rule was rescinded, and now we have a brand new rule. As part of what we really wanted to highlight to the federal banking regulators was that a law that is meant to address racial discrimination is being implemented as race neutral in a framework that is akin to this all lives matter approach. The law was written to ensure financial institutions meet the credit needs of communities they do business in. And unfortunately, even now, the new proposed rule does not include race. In 2020, they asked the public a question, should the rule include race? And from our members, and perhaps from some of you, the response was a resounding yes. And yet the proposed rule does not include race. So the key question that we're sort of left asking is, how is this race neutral rule going to address racism in the banking industry? Thank you to Ms. Radcliffe for sort of sharing that research to show that LMI does not is not the same thing as low income people of color, or people of color in particular. Next slide, please. So with that, just to emphasize why race is important to us in this conversation, the rule is 600 pages long and will focus on very particular things. Thank you. So I'll go over the details of the rule, and the specifics are granular. If you have more questions, I encourage you to email us. You can find information on our website, including my email address is there. So, but Going into what the rule has, I wanted to also highlight what the agency stated as their goals in updating this rule. So they said that they did, in fact, wanted to strengthen the achievement and purpose of the statute. They wanted to adapt the rule to, the 21st century. Mobile banking and online banking is ubiquitous, and they wanted the rule to reflect that. They wanted to provide greater clarity and consistency in how the rules are applied. They wanted to tailor performance standards to different size, model, and local conditions. They wanted to tailor data collection and reporting so that the information coming out was actually useful. They wanted to promote transparency and public engagement, things that the reinvestment community certainly repeatedly asks for. They also wanted to confirm that the federal CRA was mutually reinforcing of all fair lending laws. They wanted to, with this rule, create a consistency in the in all the regulations, which we appreciate. Next slide, please. So in the previous iteration of the rule, they have 3 lending tests, and in this proposal, the 3 become 4. And I'll go into what is in each of the tests, but please note that the different tests account for different percentage of the grade. So so the retail lending is 45%. So as you can see, very important to how the bank performance will be rated. Community development financing test is 30%, retail services and products are 15%, and then community development services was an additional 10%. Next slide, please. So what's in the new retail lending test and the bank performance metrics? So new performance standards measure loan distribution, again, LMI census tracts and borrowers. They would assess a bank's overall retail lending relative to its deposits, same as now, using a retail lending screen in facility-based assessment areas. So facility-based meaning branches. They specifically sort of move the focus on from dollars to loan units, which we think is really good. So instead of a bank making a few really large loans, we want there to be an emphasis on a bank making many loans, but perhaps smaller loans. It sort of translates into access to capital for small investors on the home ownership side and the small business side. There's a lot in the rule that applies different metrics to banks at different sizes. So if you are studying the rule and have clarifications, please do make them, perhaps in the comments or in the discussion afterwards. So I just wanted to make that clear. The lending for small businesses starts at 250K and above. Currently, it's at 1 million. So we think that drop in the gross revenue is really good. It should create an incentive for banks to lend to smaller businesses than they currently do. Lending at low income and moderate income is now being looked at separately, which again, we think that is a really good thing, particularly in rural areas. I think it should generate some more scrutiny of how banks are doing, which may incentivize them to perform better. One thing that we, pushed for and will continue to push for in our comments, which we did not see, is that when they are looking at loans, owner, occupants, and investor, there's no differentiation between whether a loan is being made to an owner occupant or an investor. And if you're following the news about investor interest in the housing market in California, you know why this is a problem. So we're sort of disappointed in that. Next slide, please. So product lines, again, you are probably familiar with home mortgage, multifamily loans, small business loans, even small farm loans. Automobile loans is new. It's probably a good thing. It will bring some more data on who the banks are lending and creating access to capital for automobiles. It's a smaller part of their test, but there's more detail there. Next slide, please. What's in the community development financing test? So I think maybe given who you all are, housing folks, this might be what you care about the most. The most notable thing is that eligible activities go from just having 4 categories to 11 categories. Some of this we advocated for, so we are still trying to really understand how this will play out, but we generally consider it to be a good thing that there is an incentive for banks to finance climate resiliency projects, finance more on native land, finance community infrastructure, particularly broadband was called out. All things we asked for, it's good. A ratio of community development dollars to deposits compared with national assessment area level benchmarks is there. You'll see that the bank must have a community development purpose. But we wondered if just having the banks identify a bona fide intent is enough. We wanted to see more emphasis on it in terms of how that translates into what they're tested for. We don't see that just yet. The other thing that is in the community development financing, and this was highlighted for me as a point that you all might care about, was community development finance institutions. So CDFI investments flat out gets credit. So what the regulators are saying is that if banks are supporting CDFIs, usually when access to capital, they sort of lift the hood and look inside. While with CDFIs, they might just blanket say, we love CDFIs. CDFIs are mission-based entities. And so all investment with CDFIs is good investment. So maybe CDFIs will see more investment. Generally, we think it's a good thing. We just happen to have had interface with for-profit CDFIs, and we'll push for some, distinction there. Some of our members fought Opportune and their application to get a bank license because they were not doing right by their customers. So we want to. Generally, we think the emphasis on CDFIs is good. We would like to see more distinction between for-profit and nonprofit CDFIs. So just wanted to highlight that. The other thing that's happening in community development investment is that they're sort of lumping together community development investments and loans. The evaluation will happen together, and some of our members are worried that it might have a negative impact on tax credits. As you may know, banks don't earn a lot of money when they facilitate tax credit projects. They earn more when they're giving loans to affordable housing developers, for example. So we're curious to see how banks are understanding this, and if in fact, it'll have a negative impact on LIHTC in particular. Next slide, please. So again, more on the retail products and the services test, the delivery system prongs, branches, digital and mobile, they are being looked at differently. Digital services are only being required for banks that have 10 billion in assets or more. I think in our comments, we'll push for that threshold to be lower. It's quite optional for banks to have digital services if they're between 2 billion to 10 billion. And particularly in rural areas, we think, it'll make a difference to lower that threshold. Credit and deposit product prongs, we thought there was some responsiveness of credit products to LMI, small dollar loans, special purpose credit programs, CDFIs. We're still exploring it, but mostly it looks like it's a good responsiveness. The number of low and moderate income customers using each product, how do they use these products, rates of successful repayment, the loan terms, underwriting process, pricing. So, these are like the questions we have and at what's being looked at. The deposit product response to low and moderate income, we would like to see there be no overdraft. And bank on accounts, we want to see the success of bank on account promotion, which I don't think it's in that rule just yet. Only banks with 10 billion or more have that component. So again, in California, particularly in smaller, in rural areas, there are smaller banks, and we wanted to see that more. Next slide, please. Assessment area changes. So I think this is a really complicated proposal. There's a lot but the thing to note is that what they're proposing is a regime where they are identifying activities that count, then where they count, and then they're trying to apply formulas on how much that counts. So depending on what your activity is, when you dig into this rule, you may want to hone in on, how are they seeing your activity in particular. For those who are following, CRA only applied to areas where banks had branches before. And now, given how banking happened, we have been pushing for activities to go beyond branch areas. So here's how they're adding to that. They created 3 different areas. Again, perhaps because you care about the community development activity the most, one of the things we noticed was community development activity nationwide gets banks credit. So we think it may be a really good thing for rural areas where, they might not have branches and branch related or branch oriented investment was lacking. Now that, the community development activity has been opened to the geographic area being the entire country, perhaps this makes the community benefits agreement conversations more important. It makes this table, the San Diego Reinvestment Task Force, whatever you all advocate for with the banks and put in front of banks as important might be what the banks are driven to do, because ultimately with the community development activity having a nationwide assessment area means they can get credit for what they're doing in San Diego, the same as what they're doing in Texas. So if you advocate better, maybe they'll do all the things in San Diego. I don't know. I wanted to that end, give a special shout out to Union Bank. Thank you for talking about your special purpose credit program. We learned from that. I think it was a meaningful victory for the California Reinvestment Coalition and the National Reinvestment Coalition. Greenlining Institute was helpful in the community benefits agreement that was negotiated with US Bank. There are 3 special purpose credit programs in there. The Mary Scott Knoll of the Fair Housing Council of San Diego gave really strong testimony at the hearing. Steve Russell, I know you also submitted a letter to advocate for the needs in San Diego. And so I wanted to give a special shout out to say, do more. It seems like this kind of communication may become more meaningful. Relationships with banks may be more meaningful. And next slide, please. So just from our perspective, overall, I wanted to go over a few things. Perhaps we are on the same page and you care about this. I've been talking a lot about race. Instead of looking at just income, we said they should look at race, and there's a tiny move forward, but there's essentially no race evaluation. So we think that's disappointing. We said that it shouldn't be that 96% of financial institutions get a passing grade. Regulators seem to think they have addressed this issue in their analysis under the new proposals. They are noting that Under this framework, a number of banks would fail in meeting their community reinvestment. So we think that this proposal would generally increase the size of the pie. Related to our point about taking race into account and considering the redlining history, we asked that there should not just be credit given for good things, but that the CRA should also have downgrades and penalties for causing harm in communities through displacement and discrimination or climate. And we don't see that. We'll continue to advocate for that with the regulators. We also urge that there be a balance between how much banks are doing and what impact that activity is having. And some of that is there in the rule. And I think, it will depend on the relationships and perhaps the activism of the local groups to figure this out. For large banks, they are looking at community development lending, lending for affordable housing and investment separately for tax credits. So they're thinking about evaluating them as in one activity pool. And as I said, we heard that before, it could be damaging to tax credits, that if they were not getting separate credits for doing tax credits, they may diminish tax credit activity or abandon them completely. So I wanted to highlight that for you folks. And number 6, we wanted there to be more attention paid to what is viewed as the services test. Are they maintaining office hours? Do they have bank branches in low-income areas and BIPOC neighborhoods? Are they providing bank accounts, particularly bank-on type fee-free accounts? We thought that there was not much attention given to this, even though this is important for people's financial stability and credit building. But they are looking more closely to what the banks are doing in this regard, but only big banks. And so again, as I mentioned, our recommendation would be to lower this threshold. In other parts of the proposed rule, they're saying that they will want more data collection from big banks, meaning like above 10 billion. And we will likely push for the data collection to also apply to banks who are smaller. Number 7, we ask for more increased community participation. For example, when the bank is having its CRA evaluation for, this task force to be able to actually provide input. We're not really seeing it, so we'll continue to advocate for that. And then, it seems like they're doing a pretty good job of balancing underserved areas and those with branches. That might mean that native lands and rural areas see more investment. And then there's, for us, it's also in terms of implementation, the other side of the coin. It could, whereas their focus on, bottom line numbers may mean more investment for rural areas, and their, redefining assessment areas may mean more investment for rural areas and native lands. We also wondered if that would be sort of a loophole in pulling away from LMI and more local activity. I think I'll stop there. Next slide, please. I think it's just my information more on race. I don't know if you want me to remind you more of these things, but for us, one of the things I'll say is, when we think about race and home lending, because the previous speaker was also talking about this, in the performance evaluation, we think it's a good thing that they are saying that the Homeowner Disclosure Act charts by race will be included, but they're also saying that it won't impact ratings. So we think they came so close to doing something about racialized or disparate lending, and then they somehow pulled back from it. So we think there will be little benefit to just including that data, but somehow not holding banks accountable for what that data has to tell us. Yeah, and then I'll stop there, see if you have any more questions. Next slide, please. My email address is there. If you have any information or comments, please let us know. As Daisy mentioned, the comments to the federal regulators are not due till early August. CRC will write up a sample letter and our own comment letter, which we make public. Will most likely solicit input on our own comment letter before we submit it, meaning the way that we are interpreting the rule, we'll make public to you all because we see you as our partners. So if you disagree with us or have, sections of the rule we should read or reread to, somehow better inform our opinion, we'll welcome that. We want to make sure we get this right in community. So please remain in communication with us, and any feedback is most welcome. Thank you so much for having me.
Thank you. That was very thorough. A lot of information there. Certainly appreciate you being with us this afternoon. I am going to turn it over to public comment, and I just want to make sure that the public knows I won't be reopening public comment once I close it. So if you have something to say, please, 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 we want to hear from you. And I will turn it over to Polly to please proceed with public comment.
We have one public comment. Guest attendee Z07418. You can unmute yourself and begin your public comment. You have 3 minutes. Guest attendee Z07, you can unmute yourself now and begin your public comment.
And made a mistake.
Guest attendee Z07, if you would like to make a public comment, you may do so now. It looks like you are unmuted.
I am sorry, I made a mistake.
Okay, no problem.
So sorry.
No problem. And there is no public comment at this time.
Okay. Anyone in the public wish to speak? All right. And we're going to close public comment. And now I want to turn it over to the members of the task force to see if there are any questions or comments here. Okay, I just have one, and then I'll turn it over to you, Daisy. But it is about including race evaluations, and I've been in these conversations a lot, not with this particular topic, but on the reparations task force, because in California, we have laws that are strictly prohibitive of that, and I know this is on a federal level, right? And we talk about the strict scrutiny standard with the 14th Amendment and all of that. Not trying to make this a legal forum necessarily, but I do want to know if there have been conversations around that, or if there's some hesitation because of that on the federal level. I just want to know if folks are seeing it as something that they can legally do and just aren't doing it because there's not enough political will, or are there other reasons?
I mean, there are banks here, so maybe they know more, but whenever we've been in conversation with the regulators, and we were just last week as well as part of the National Reinvestment Coalition's Advocacy Week, one of the things that came up for us is, when banks talk about not wanting to collect, a thing on the form that says I'm Black or Latino or Asian, there's that hesitation. However, I will say that you only just have to look at most of our names to already know that information. Mm-hmm. So to some extent, for not holding banks accountable for disparate lending, where we can see that people of certain races, when they meet the credit when all other things being equal, they're not getting access to credit. There has to be some accountability. So to answer your question, I think yes, that is often being used as a what we would say excuse for not doing this work, but we do think that needs to be rectified. The data shows, as you know, the previous speaker was also pointing, that we have a problem that's not going away without it.
Right.
Black home
Yeah,
ownership
and
is just as low.
and race neutral solutions don't really change that, as we've seen from your presentation, the presentation prior to yours. So yeah, thank you for that. And Izzy, please.
Thank you, and thank you, Joe Tarup. This was a lot of work, a lot of information. I think we're all digesting it, and we will pour over it. But we really appreciate what you've done. The analysis is just really starting to come out in the last week, and so you hustled to get all of this to us, and we're one of the first to be able to benefit. I did see the NCRC on its Treasure CRA page is coming out with a preliminary analysis too. So we'll be pouring over all of that and starting to prepare our own letter. The comments that I'm hearing, nationwide, again, are this disappointment that this is kind of a once in a generation opportunity to rework CRA. And especially now, as we're still, these racial gaps have not been addressed with the existing system. What are we going to do differently? And there's a lot of disappointment that that's not showing up. So it'll be interesting to see if they can figure out between now and when they release the final rule, maybe some way to move on that. Personally, I'm concerned about, is investment going to flow away from CRA hotspots that are either easier to do because they have a sophisticated infrastructure like we do, and our partners like Wakeland, but also we're higher cost, right? And so that makes the deal harder to do, harder to subsidize all the way around. So as you look at national assessment areas for community development lending, what's the impact going to be there? Because certainly we already think there isn't enough in San Diego, that we need more, but we'd like to at least hold on to the level that we have. One great thing about the new rule, though, is that it will be much more rigorously quantifiable and sort of objective instead of subjective. And there is movement, and we'll probably see that in comments and add it to our comment to make that transparent as well. Like, okay, if this is objective information, please make it public so we can also assess the performance ourselves. So again, thank you, and thank you. To be continued.
Thank you for being with us this afternoon. We appreciate all the information that you've given us. We are now going to turn to item number 8. It's our last item of the day, and that's the information item and update on a home ownership equity project. I'm just going to give a couple of opening comments, and then I will turn it over to Daisy. So I just want to just tell everyone congratulations to all who were involved in the Wells Fargo Wealth Opportunity Restored through Home Ownership Grant. It's a really heavy lift to have 6 months to create a plan that could potentially create up to 5,000 Black, Indigenous, and people of color homeowners in San Diego. And we certainly understand what we are up against. We've heard it today, increased home prices, all of the discriminatory policies at different levels of government, decades of those. Recently, San Diego has made news for surpassing San Francisco as the most unaffordable housing market. So there are a lot of challenges here. And as we heard, this plan is, as we will hear from all of the partners, the plan is extremely comprehensive, very, very ambitious. And we'll hear more about that later, but it's very competitive. And so I want to say that some of you know this, some of you don't. There are no official statements. Official statements are still pending. But I'm excited to share with you all that we were selected as one of the 8 regions to implement this large grant for BIPOC homeowners. I am asking all of us to not share that on our social media. We have probably millions of followers collectively, and also to the public. we want to make sure that our official statements are very comprehensive so that people actually know what this means. But I think because we've all worked so hard on it and been kind of in the loop, it's important to share that. And so I know we're ready to go to work and complete these goals. And I'm very excited about it. I just have to say, I want to thank everyone, but I have to thank Karen from my staff who worked really, really hard. This is something that I think was a heart project for her. And so she put a lot of time into it. And I just want to publicly thank her. So thank you, Karen. I know your camera's off, but thank you. And at this time, I'll turn it over to Daisy.
Thank you, Madam Chair, and thank you to all of the partners. This is so exciting and daunting, as we talked about, but what an honor and what a tribute to all of the work that especially the executive committee did. We've got here, on the RTF MAC project, LISC, but our other partners, Urban Institute, Logan Heights CDC, NARAB and NAREP, the realtor groups, and then the divisions within the Housing Commission, the First Time Homebuyer Program, the Achievement Academy, and our Racial Equity Office. And if I forgot anybody, I really apologize. I think I got the executive group, but we have, a couple dozen partners. Beyond that, we had an 80-page application and a lot of help. So kudos to everyone. We got, as the council member said, one of 8 across the nation, $7.5 million to work over 4 years to create 5,000 new BIPOC homebuyers. As I said earlier, in general about this market, we have no illusions about how hard it is, but that makes it all the more important, right? And that we bring new tools and create new systems, because what we're doing is not getting us where we want to get to be. Luckily, with 4 years, I look at this, we're playing a long game. What we've seen with the interest rates in the last couple of weeks makes it even more frightening. Personally, I hope it's going to take some of the froth out of the market and help our people. But that won't happen in the short term. In the long term, we're going to create an ecosystem and infrastructure for helping more people to get ready and to creating more products that will help them. And then see our fruits and count them within the next couple of years. So we're getting to work. We brought this back as an item today, not just to share this great news, but because when we shared the program with you in March, we were still in the throes of a national competition. So we held back a lot of the details, but we'd like to preview them to you so you have a sense of what's going to be coming and where you can get involved. So Michelle, if we could share screen, please. I'm just going to run through some of the details that we didn't share. Looking at the clock, all right, and then we'll do a quick discussion and I'll tell you what's coming up next. Let's go to the next slide, please. So as we shared at the last meeting, the 11 strategies and activities, the 11 activities fall into 4 cones or strategies, and we've called them the 4 Ps: preparation, products, partners, and policy. Next. So the first one, preparation. This is, next slide, please, Michelle. I'm sorry, I'm looking at 2 screens. I'll put away my screen. Next slide, please. Yes, I'm going to move this over. This is why I have help. This is the developing a pipeline strategy. This focuses on consumer preparation, homebuyer preparation, and giving them the information and the resources that we're looking for. This is something that we've talked about at the RTF in the past, creating a central information site. We're going to go a step farther than that. We're going to create a virtual homeownership center that is a one-stop shop and a portal into the process. As you'll hear in the other strategies, it will connect you to vetted professionals who you can trust and who have been trained on working with BIPOC people and some of the mortgage assistance products that we've talked about. It will also connect you to counseling, debt repair services, if you so desire. We are looking to have an automatic assessment tool on it as well that will kind of say, oh, here's where you are. Oh, you don't need any help. Oh, look at that credit score. Look at your debt. Here's, would you like some connections to vetted real estate partners? The other 2 activities, number 1 and 2, get to that counseling and coaching component. The first one is, well, the second one is the routine stuff that we know the numbers just haven't been great, and they are a barrier to home ownership in addition to down payments, as we all know. So reducing that debt to income level, and so you can carry more over mortgage and not be burdened, right? Repairing credit, raising credit scores. Right now, a lot of those programs they either touch existing clients, like the housing commissions, work with housing choice voucher folks, or particular properties or projects that we're working on, like the Promise Zone, and or they serve 80% and below. And as Carla Ruiz said, those are the hardest to serve. We want to serve them too. It's part of this grant. It will continue to be a focus, but they are not by any means, as Yannicka said, that's not the whole population that we're looking at. And certainly if you look at middle income and higher income folks who are also covered by this grant, they have the highest income for home ownership, but they don't have access to a lot of these services, and certainly not the nonprofit ones and the certified counselors and coaches that a lot of our programs work with. So we want to create the infrastructure to expand those services to different groups. Same time, we want to make them appropriate, culturally appropriate. We want to look at, promotoras, maybe support groups. Maybe in both, we're leveraging peer-to-peer education. I've often thought, anyone's talking privately says, what about, a Weight Watchers for home ownership? People who we learn from each other. That's how we all learn. And you can encourage each other and learn from each other. So we'll look at setting those up, expanding them. We will also have navigators for the whole system. Right now, a lot of our real estate agents are doing that. We'll continue to work with them and rely on them. But if we can help expand that bandwidth, if you are coming from a community, a family that hasn't had home ownership yet, you don't have like an in-house navigator. And so we'll create those connections. We'll go to the second one, please, Michelle, the next slide. The next strategy is financial products. This is everything from creating new products, expanding existing ones that we know that work, and strengthening the ones that we know that work. So there is an activity around expanding and strengthening government-assisted or government-provided down payment assistance programs, working with the lenders who do not participate in that program to find out why. Do we need to change something? Sujat has been really great about listening, and the realtors have been participating through our listening sessions too. We are looking at how can we, the pooled loan fund that we've been working on at the RTF the last couple of years to expand the amount of assistance that can be provided, that will be under this cone. Programs that we know work too, like the Black Homebuyer Grant that Ricardo's talked about, Frank mentioned, how can we strengthen and expand those? And then last, are there untraditional mortgage providers with lower interest rates that we can bring to this region who are not here now? That is the last cone, as well as there's some partners that we've talked to here in San Diego who have developed some great programs. I don't want to out them yet, but there could be some unusual occupation-tied pathways that we'll be bringing there. Next slide, please. This next part is something that we're so excited about and feel is so important. We heard at the last meeting, we heard from MAC Projects researchers about the trust issues that they have with realtors, lenders, the lack of cultural competency, the feelings of discrimination, or the just discomfort. Somebody who said, her husband has a bit of an accent, and the provider they were talking to kept saying, what, and made him really, really uncomfortable. Any of us would be. So we want to have a network of vetted, trained partners, and we want them to commit to a certain level of production as well. Right now, you have folks who participate in programs, they've gotten trained, they can put their name out as saying they do it, and then they don't do anything. So we want to talk to them and find out why, but we also want to make sure that we're referring our home buyers to people who will help them and will not discourage them or not people who will answer their calls. Even that is an issue. So that's what these two, the two activities in this one around are: identifying those folks, creating the network, training them, providing continuing education, establishing a certification process. The last cone, next slide, is aspirational. It's housing supply solution strategy to, as we heard when Steve talked about the middle income working group, any of us working with this know, increasing supply, creating, and also especially building at that lower end of the market instead of these luxury properties is an important strategy for holding down the price of housing in San Diego. We want to make sure that the BIPOC home buyers benefit from that. As we heard, I forget who was talking about, investors are coming in, and there are some really exciting, innovative things both in the working group, the mayor's working group recommendations, but elsewhere, pilots that are being done or imagined, and we want to fuel that and support that. So those activities around implementing the mayor's working group recommendations, increasing supply through pilots related to either finance or construction innovation, and seeing what we can seed. Overlaying all of this is going to be a rigorous data collection effort, which will be led nationally by Urban Institute and Yannicka Shah. So we're looking forward to working with them. And then the other piece of it, of course, is connect once we've set up this infrastructure for the consumer, connecting to them. And so we have a lot of creative ideas around that, whether it is for those 80% folks and below, reaching people where they are if they're already in affordable housing properties. For the higher income, well, for all income levels, I should, you check yourself. Working with major employers and anchor institutions to get the word out about the services and to reach their employees. And then doing more consumer-oriented advertising outreach, the traditional kinds of work. There's a lot of work to be done. Michelle, let's go to the last slide. So these are all the folks who are going to help us with that, who have been helping us with that, either by providing a letter of support and thought leadership to us. The ones in bold were now I can look and see whose name I left off. That was our executive committee, who worked really closely with me for these last 6 months, and they will continue to be part of, exercise leadership of this overall collaboration. Michelle, we can stop sharing, please. The next steps are, the reason that we're still a little quiet about this is that this is a big deal. We want to do like an official announcement with the press, with Wells Fargo VIPs, and it's just a matter of scheduling them, especially since they're scheduling 8 around the country. So these are all really early days, but if we tell everybody now, then it's not going to be news when we try and get some traction later. So that's been fun trying to no, it's fun. No, so we are working on that on the back end. The grant came to the Housing Commission as the fiscal agent for the collaboration and for the RTF. The RTF is providing the backbone staffing for this collaboration. Our lead partners who have been assigned to these various strategies and will be doing a lot of the heavy lifting and distributing the budget are the RTF, MAC Project, LISC, Housing Federation. And then, of course, our realtor groups are going to be really key. Some of the folks around the innovation include Habitat, Civic San Diego, Civic Communities. And so we're trying to get that all set up. We will be reaching out to everybody shortly, within weeks, as we try to figure out what that looks like, probably pulling some people in to figure out what that looks like. I have a new appreciation for how complicated this is and is going to be, but what an opportunity. So thank you everybody who has helped and for your support. We'll be in touch.
Absolutely. Let me go to Antonio as part of of course, the presentation, the major partners. And I thought I saw a public hand, but I don't see one now. I'll just go back and make sure that the public, but I want you to speak first, please, sir.
Thank you, Council Member. Just really fast, I just wanted to give a special a very special shout out to Daisy, not for just the difficult task of coordinating the efforts of the collaborative, but for her key role in putting together a solid application that it's going to bring the grant to the region. I think it was not an easy task, and obviously be careful what you wish for. It's going to be a lot of work, but I think it was kind of a Daisy behind the scenes putting together this. So I just wanted to give her the special shout out to Daisy.
Ditto. Thank you so much, Daisy. This is just, thank you. It's been tough, but you know, you put the pieces together of who could actually do this and convene that. So really do appreciate you. And I just want to make sure, check in with Polly and make sure we're not missing any member of the public who wanted to speak on this item.
Any attendees wishing to provide public comment may indicate so now. There is no public comment at this time.
Okay, thank you. Yes, it's the sooner we can kind of get everyone together and make an official announcement, the better. There's been some things already said out there that I'm not happy about, not by anybody here. But I just have to say it, and mainly because there's so many people that work so hard on this, and they're the ones that deserve to, you know, officially announce, right? And so I want to make sure we're doing that. So if anything additionally that I can do, Daisy, let me know. But we are waiting on you, so it won't go before you. So just let us know. Okay, anyone else? I don't see any more hands. So thank you so much, everyone, again, for your time. Today's meeting is adjourned, and I will see you at our next meeting on September 15th. Thank you, everyone.
Thank you. Thank you all.
Bye.